Okay. Welcome back, everybody, to a more normal video here where we're taking a look at Intel, ticker symbol INTC. And before we get started, I want to take a moment to give a huge shout out to Edwin Lee. Thank you so much for your comment on one of my previous videos. Edwin here suggested to do a video on INTC, so great suggestion. This is an awesome opportunity to check out a company that has really been struggling while the rest of the industry has just absolutely taken off. I mean, Intel's competitors, NVIDIA, AMD, Taiwan Semiconductor, it's nothing but up for a lot of them, and Intel has been, well, the opposite. Before we jump into the financial numbers, I think we should take a look at some recent news, figure out what might be causing Intel's problems. And starting out strong, we have the retirement of Intel's CEO, Pat Gelsinger. And this is probably the most worrisome thing for me. He retired effective December 1st, except Intel didn't announce this until December 2nd. So it was a very quick exit. And if you know the story, the background story of why Gelsinger was hired, he was actually a long-time employee, a very high-ranking engineer for the company. He had a 40-plus year career, most of it with Intel. He ended up leaving the company, but they brought him back to turn around the company after Intel basically lost a ton of ground, both in the market as well as in technological advancements to companies like AMD and NVIDIA. So his sudden exit, only a couple years after he was hired, was quite shocking and quite telling, in my opinion. The next headline, this is actually from today, the day I'm recording this, December 19th. Intel has been sued by its shareholders over its foundry. Now, Gelsinger and many other people at Intel thought the best thing to do was to build a foundry business to compete and basically be a vertically integrated chip designer and manufacturer. It's cost a lot of money. And if we go down lower here, the shareholders are suing because of the company violating securities law with their fiduciary duties, unjust enrichment, and wasting corporate assets. In parentheses, that basically reads that people are sick of Intel spending money. And I think it is really interesting. The unjust enrichment part to me is the most intriguing because Gelsinger himself was paid $207 million between 2021 and 2023, which is a ton of money even for CEOs. I guess it just kind of goes to show that a CEO can be paid a lot of money as long as the company continues to perform and the stock continues to perform. Think about like Elon Musk and Tesla. But if you're Gelsinger getting paid $200 million and the company is continuing to struggle, well, now it is unjust enrichment instead of, getting paid your fair due. So the foundry company has been basically bleeding Intel of cash and investors are sick of it. But I do want to point out that this company, for all of the negatives that have recently happened, and I haven't even covered, the balance sheet and earnings and stuff that you'll see is pretty awful. There is still plenty of optimism for what's coming. There continue to be groups of people that say that Intel is going through a bad 2, 3, 4 years, but they will come out of it much stronger. And that is essentially what this article here is referring to. The 18A makes Intel's foundry more valuable than ever. What does that mean? The 18A stands for 18 angstroms, if I'm not mistaken, which is basically 1.8 nanometers, and that would be the smallest scale chip ever produced. And we can see down below here that Intel's next-gen 18A fabrication process is almost ready to roll out, and they consider it to be the most advanced yet. I believe Taiwan Semiconductor, which is Intel's largest competitor in the foundry business, their best is a N2, which is 2 nanometers. So 18A is essentially 1.8 nanometers. It's smaller. The smaller that you can make your nodes, the more power you can pack into it. The more power makes the chips, stronger, right? Able to output more. So that's kind of been the entire theme of chips ever since their invention is let's pack more and more nodes into smaller and smaller places and into increments, more dense, I should say, not smaller, but more dense nodes. And that is how computer processing power has essentially just continued to get stronger and stronger. So it's a big deal that Intel has a slightly smaller nanometer size. Whether or not it'll prove to be as big of a deal as some people think, we'll find out. And then finally, through all of this other noise, we see that Intel leaders, the new Intel leaders, say that breaking up the company is an open question. Essentially, these leaders appear to be looking to break off the new foundry system that the company has sunk so much money into, making that its own company, Intel is exploring the sale of a couple of its subsidiaries as well to raise cash. And then Intel itself, depending on how much they want to break up the company, might turn into a pure design company similar to like NVIDIA is now. So that remains to be seen if the company will be broken up. And I personally believe it's probably better to keep the company together and go for that vertical integration. But, the new CEOs have their own vision. We'll see what they do in the future. So now that we sped through some recent news, we are ready to move on to the income statement, cash flow, balance sheet, as well as taking a look at the company's valuation. But before we do that, please take a moment, like this video, subscribe to my channel, leave a comment down below with your thoughts on Intel or asking for any other stock that you'd like analyzed. It all means a ton to me. It really helps a small channel like me grow. So thank you so much for taking those 2 seconds. And with that, let's take a look at the income statement. Now there's going to be a lot of charts, but basically let's just take a look at the broad strokes here. What we can see is that revenue is down almost 7% per year for the last 5 years, and gross profit is down 15.25% per year for the last 5 years. But cost of goods sold has been basically flat, as well as their selling, general, and administrative expenses. What's even worse is that research and development costs have gone up by about 6% per year. Operating income is basically zero, so I can't even create a compound annual growth rate. But all of this is really pointing out to a company that's earning less money and spending more money. Intel's net interest expense is positive, which is actually a good sign. It means that the company is earning more on their cash on hand than they're paying in their debt. But it's a very brief interlude because continuing operations continue to fall, negative $16.42 million. Revenue per share is down 6% per year. Diluted earnings per share down to negative $3.76 per share versus where it was just a few years ago at about $5 per share. The company has started to reissue shares at the open market, so they are diluting your ownership. Not to mention that EBITDA and EBIT are both struggling mightily. I will make a brief mention that Intel does show that it paid a dividend, but the company has announced cutting that dividend largely because their payout ratio was, it's set at 999, but it was basically they were paying out a dividend at the same time as they were making absolutely $0 in free cash flow. They were losing money. So, in my opinion, a good call by management. Intel has generally seen a drawdown in inventories, which is a good thing. It means they are selling their products. But capital expenditures continue to get more and more negative, meaning the expenditures are growing. The company has also issued net debt every year for the last 5 years. 2023 was an awful year. 2024 does show promising signs. Only net debt issued is about $700 million, which is minuscule compared to how much debt the company's taken out in the past. But of course, we can see the levered free cash flow number here, currently sitting at negative $9.3 billion, which is pretty ugly. It is improving from 2023, but it's still pretty ugly. The balance sheet does hold a few bright spots. Cash and short-term investments has been basically stable, so the company is holding on to its cash. So the company is maintaining a cash pile. Total receivables took a huge dip in 2022 and 2023, but there is some life coming back in 2024, so hopefully the company is able to continue growing that. Inventories are rising, but below 2022 levels when the company had major inventory and selling issues. We are seeing a growth in total assets of 9.12% per year, which is good considering all of the negative numbers we've been seeing. But the company's long-term debt has grown at 16% over that time, and the total liabilities have grown at nearly 11% per year over that same time frame. So total assets are growing, but the total liabilities and long-term debt are growing at a faster pace. Total stockholder equity is growing at about 8% per year, so that is still a positive, but again, slower than all of the company's liabilities. Cash per share is up 20% per year since 2019. Book value per share and tangible book value per share have been growing nicely, 6.3% for book value and 15% for tangible book. So the company is still maintaining decent assets that, if it were to liquidate, would provide value to investors. But of course, net debt value also growing quite quickly, currently sitting at a net debt of $25.2 billion. And finally, taking a look at Intel's margins and leverage, it's a pretty ugly page here. Gross margins falling from 60% to 40%, operating margins from 30% to negative, free cash flow margins very negative at negative 17% right now. Their return on assets also negative at just about 10%. Return on equity negative 15%. So the company is really struggling to earn money on its investments currently. Of course, there are proponents of the idea that this is a temporary situation and the company will start earning money and seeing returns on the investments shortly. But as of right now, it looks really, really bad. Intel's also seeing a deteriorating current ratio, although it does still sit at 1.31, which would be considered healthy. Anything above 1 is considered healthy, although obviously the higher the better. Its quick ratio is 0.97, which is fairly okay. Being above 1 is ideal, but there are many types of companies that are much lower than 1, and it's normal for them. Intel's cash ratio continues to fall as well, in line with just about everything else. The company's long-term debt to equity growing, and its long-term debt to EBITDA has really risen sharply. I mean, up until 2021, it was below 1, which is really, really solid leverage, and it's jumped now to 4.45. That means it would take the company about 4.5 years if all of the money it earned on an EBITDA basis was spent at paying down the long-term debt. Now, it does have some pretty low EBITDA numbers right now, so we could see this ratio sharply drop once the foundry business starts earning money and they're not spending tons of money on it, but for now, looks pretty bad. And again, long-term debt to EBIT looks ugly, mostly because EBIT was super low in 2023 and negative in 2024. Long-term debt to free cash flow, it was 20 times covered just in 2021, and now the company makes literally no free cash flow. And to quickly gloss over Intel's interest coverage, I mean, basically its EBITDA, EBIT, and free cash flow are all so ugly that it doesn't cover their interest currently. So this is the part of the video where we move on to checking out valuations and seeing if this stock, even as ugly as it looks, still presents a good value for investing today. So just one last time, if you could please take a moment to like the video, subscribe to my channel, and leave a comment down below. That would all be so amazing. It is free 99 to show some love and support, and I would really appreciate that. Thank you so much for watching this video. And with that, let's figure out what Intel's fair price is. On a price to sales basis, Intel currently trades at 1.6 times, which is 43% below its long-term average, although that's probably pretty warranted considering the company is burning cash right now. On a PE note, Intel's current price to earnings ratio is negative thanks to its negative earnings, but on average, the company's traded at about a 15 to 18 times earnings. The average of 23 times earnings is really only skewed by 2023 when their earnings were super low, but the stock started to rebound for a short period of time. But if we use this 23 times as a fair value, which I think is okay given the growth expectations that we'll see soon, by 2025, we should see that Intel is worth about $22 per share. So it's basically trading around that value today. And in 2026, the company would be worth about $40 per share. So if you're patient and analysts are correct, Intel could be a decent and lucrative investment today. Digging further into the ratios, its price to EBITDA is currently 8.29, which is pretty well below its long-term average price to EBITDA of 9.62, representing a 14% discount. Intel's price to EBIT and price to free cash flow are basically useless at this point because a lot of these large and small numbers and the swings between positive and negative have made our averages quite skewed. But to me, this might be the most interesting part of analyzing Intel, and that is the book value and tangible book value. This company is currently trading at a price to book of 0.88 times, which is really low, essentially half of its long-term average of 2.09. So if Intel was to return to just its average price to book value of 2.09, we're looking at a stock worth $48 per share. Tangible book is even more undervalued, currently trading at 1.24 times tangible book, which means the company is almost trading at literally what you would get if you liquidated the entire company, which is pretty insane to think about. And if Intel was to return to its average price to tangible book of 3.5 over the last 5 years, the stock would be worth $57. Now, do I think it's worth $57 today? No, but that is a reasonable target over the next few years if we see some multiple expansion on the price to tangible book basis. Dividend yield is basically useless since the company cut its dividend. But if we're taking a look at enterprise value to EBITDA, which factors in Intel's debt along with its market cap to get to the enterprise value and compares that against its earnings, we can see that it's basically fair value. It's valued at about 0.13% higher than its long-term average. But even then, I do want to point out that its long-term average over the last 5 years is 10.7. So if Intel is able to figure things out, we should see some multiple expansion on the EV to EBITDA front for sure. Again, free cash flow is super skewed, so it's not very helpful. And our 10-year drawdown chart really just lays out what a mess Intel has been, especially since about 2020. The company's currently in a nearly 70% drawdown from its all-time high, and it has not reached an all-time high since 2020, approximately January of 2020. This is one of the largest drawdowns in Intel's history. and it remains to be seen if the company is able to get out of the drawdown. But if Intel was to return to all-time highs eventually, I mean, that would be some very large gains in your pocket. And then to quickly cover some X factors, the 5-year expected growth for Intel is 25.24% per year for the next 5 years. This is why I believe that the PE of about 23 that we saw earlier in the video might be a fair value PE for the next 5 or so years, because Intel is expected to grow at a much faster rate than it has in the past, as long as the company stays together. Our PEGI ratio and FG ratio are both negative, skewed because of the fact that their earnings is negative, their free cash flow is negative. So I'm not even going to really bother explaining these because the numbers are useless for Intel. And finally, for a brief recap of this stock, what I do personally like is that Intel is in a critical industry. I mean, we all need semiconductors in our life, and so that kind of gives it an unfair advantage where it will be useful to some extent for a very long period of time. Intel's success is also an American priority. A ton of American government federal money has been sunk into getting Intel kind of off the ground and getting that foundry business started. Why? Mostly because the world relies on a few cities in Taiwan to make a ton of these semiconductors, and Taiwan isn't necessarily in the safest neighborhood. Geopolitical and geographic diversification is super important, especially for the United States. So Intel is going to benefit from all of the free money that the government gives it. And then third, Intel really does not have that many competitors if you think about it. Their direct competition in the foundry business is basically only Taiwan Semiconductor. And then when it comes to chip design and processors, you're looking at companies like AMD, NVIDIA, lots of other smaller chip companies. But at the end of the day, very few companies have the just sheer size that Intel has, and there is not a single company in the world that is attempting to be as vertically integrated as Intel is. So that lack of competition also provides Intel a lot of staying power, even if the company is going to struggle for a period of time. Now, what I do not like about Intel is that it's losing market share. We didn't really go over any of those numbers, but I mean, if you're a gamer or if you keep any sort of eye on the technology sector, I mean, we're all talking about NVIDIA, we're all talking about AMD's stuff. Intel is kind of slowly fallen by the wayside. It used to be the leader in so many different categories, and now it's just struggling to keep up. And speaking of struggling, not just from a business perspective, but also from a technological perspective, Intel has really struggled to catch up. Now, there is some promise, as I mentioned earlier, with their 18A foundry, but for many, many years, Intel has just continued to put out products that underperform against competitors. That is starting to turn around, but in a dog-eat-dog world where the best hardware really winner takes all, Intel cannot afford to be the second or third or fourth best on the market. And then third, and this one might be the biggest one, is the high upfront cost structure for building the foundry business, getting Intel back on track from a research and development perspective. I mean, the company has thrown billions and billions of dollars at its turnaround. The United States government has thrown billions of dollars in subsidies for getting the foundry off the ground. I mean, this upfront cost structure, if for any reason a factory gets delayed, I mean, Intel's costs are just going to continue to skyrocket. And so I think this presents the biggest challenge for the company today, which is controlling its expenses. So with that, those are my brief thoughts on Intel. Me personally, I think it's a very interesting stock to watch. I will continue to watch it, hope that it drops even further, and I might consider investing in it if we do have one final waterfall moment where the stock price just collapses. I do think long term there's some really good potential for Intel. It just remains to be seen how long we have to wait for that long term to play out. So, what are your thoughts on Intel? Did you learn anything new? Please leave a comment down below if I left anything out about the company that you find interesting. And let me know about the new format too if you have any thoughts on that. So with all of that said, thank you again so much for making it to the end of this video. You are an absolute beauty. If you have not already, please like the video, subscribe to my channel, leave a comment down below with your thoughts, whatever you want to do. Just watching the video all the way through is amazing payment enough. So with that, I hope you have an amazing day, and I will see you in the next video.